calculation of net interest expense and income we included, and the balance sheet was matching, right? The only thing left in this whole model is my short-term debt, correct? Everything else is completed when it comes to the model building part. So now we need to calculate the short-term debt. For short-term debt, we need to create a portion just above the short-term debt, which is known as cash after mandatory payments. So we need to understand how much cash we have after paying off all the mandatory payments, correct? So for that, what you need to do is you need to bring the cash flow completely here. And the way that I'm doing it, you have to do it like CFO, copy the CFO part, and I will paste it here. Then CFI, which is investing activities, bring that line item here. And then all the line items of this equity issuance, equity. So like the complete CFF, but I will not include short-term debt itself. I'll just include the remaining portion, copy and paste it here. So these are the things. And we also need to have cash and cash equivalents, which is a beginning balance. Okay. So let's go one by one. So I need CFO. This is my CFO. I need CFI investing. I got my CFI investing activity. Then I need equity issuance. Equity issuance is this. Then I can drag all the things that I have got: equity repurchase, dividend, debt issuance, and repayment, and drag it for the next 5 years. So I've got all the numbers. I now need the beginning balance of cash, which is equal to, this is my opening cash or beginning cash, which is 43,000. So everything is now has come. You'll check the total. This is nothing but your cash only, like 59, 87, 117, 156, and 203. You can check it from here: 59, 87, 117, 116. So this is a total cash balance that you have brought it here, but you have given a breakdown of that total cash. So that is your total cash. Can we say that it is after mandatory payments? What are mandatory payments? Mandatory payment is this payment, which is your investing activity. Dividend, which is a mandatory payment. I mean, mandatory means not mandatory, but they are paying it. That's the reason I deducted. And interest. So everything after deduction, you have this as your ending cash or cash after mandatory payments. Now you tell me, do you really need to raise a short-term debt? If you look at this number, like you have so much of cash, right? Do you really need short-term debt in your business, in this business? Yes or no?
Yes, sir.
The point is you already have a lot of cash sitting on the balance sheet. So in such case, the chances are that you may not need short-term debt, because if you have a lot of cash, why would you raise debt? But still we need to check. We will do short-term opening and closing and issuance slash repayments. So repayment is bracket, means it is a negative number, and issuance is a non-bracket, it is a positive payment. So we can bring the total short-term debt of the last historical year. So that was your 0, means initial ending was 0. Next year also the closing of last year will be opening of next year. And we can put a sum. So nothing is there in the short-term opening and closing, but we need to check, do we need debt or not? So for that, I have a formula that you have to use, is equal to minus MIN minimum, bracket open, select the cash, comma, select the opening balance and drag. So this model, this formula tells you that you do not need cash, considering that you have a lot of cash already. So that is the reason it is coming 0. And what you need to do, you need to sort of link these two things in the operating model. So first is short-term debt issuance and repayment will go to this short-term debt issuance and repayment portion, which is 0. This is the one. So you're not raising anything. So cash flow should have that point that you are not raising anything. Second thing is that you need to bring the closing short-term debt. So closing short-term debt will come here, which is the closing. Now I'll tell you how this schedule works. And I'll just not just close this thing just by looking at it is 0. So there is no difference, but you need to, I'll just show you how this works in a real manner. Now this model is completed because we have now successfully have the short-term debt also, which was left. And this was left, this is also completed. So there's nothing which is left in this model. If you look at it one by one, everything is completed. Now we can do the testing of this model to some extent. So what I'll do is just to make this understand this point, how this model, how this issuance repayment is working with the formula minus min in this, I need to make some expenses in a way that this becomes a negative number. The moment cash becomes negative, then you may need short-term debt. So what I'll do is I'll take some random dummy examples. So suppose you are doing a repurchase of 40,000. It is just a dummy number. I'm just assuming that it is a thing that you're doing. And here also you need 50,000 of or 60,000 of repurchase. Again, just as a dummy. I'm keeping dummy as red numbers. Here, suppose you are doing a dividend payment of 20,000. Then on debt, suppose here you are doing, let's keep 40 ki jagah pe, let's keep 50. Okay. And here also, suppose you are doing a repayment of debt, right? So this is, say, suppose 13,000. Now see what has happened to your cash flow. This is negative, means you have done a lot of expenditure, like you have done an equity repurchase of 50,000, which is a dummy number. You have done a debt repayment of 13,000, which I just mentioned. You have done a 20,000 of dividend. These three things I have done as, I mean, intentionally I'm making an expense. Are you getting my point? Because of that, your cash in 25 is negative, then it is positive, again it is negative, again it is positive, and again it is positive. Now what has happened is this. In your short-term debt, try to understand this point that you had a shortage of cash as 3452 by making an expense here and here, or any expense that you make. The short-term debt is suggesting that you should raise 3452 of debt because there is a shortage. You can't have a shortage in your debt account, in your cash account. So whatever shortage that you have, you will get it as a cash. Sorry, you will raise that much amount as debt. So shortage was there, you raised that much of amount. Your total debt was 3452. Next year, there was a surplus money. So you thought to pay back 3452. Are you getting my point? And then again, your short-term debt became 0. Next year, again, there is a shortage. You again raise whatever was shortage, 24,451, you raise that amount from the short-term debt. So there was an outstanding. Next year, there was again a surplus. So out of 38, you paid back 25,000 of repayment. and again there was a zero. Next year there was a surplus, there is no need to raise the debt. So it works like a credit card, isn't it? That suppose there's a salary, there is a shortage of salary, you raise a credit, you use a credit card to make a payment. Next year you got another salary, there was a surplus, you paid. So you're getting my point that how this is working, this short-term debt. Connect Mr. Nallu, Priyanshu, Rochan, and Somil.
Yes, yes, sir.
Yes, sir.
So that is the reason why this short-term debt is required. We also call it as sweep in, sweep out facility. I think you may have seen in your bank account that whenever you have excess cash, banks gives you an option to invest. And whenever there is a shortage, they give you the money back. Or in other words, you can say overdraft facility, credit card, all credit card overdraft works like this only, that these are short term in nature. Whenever you need them, you get the money. Whenever you have an excess, you can pay back. Okay. So that's about your short term debt, and the model is complete.